Welcome to This Explainer, where we're going to explore the catastrophic downfalls of some of history's absolute financial titans. We're pulling back the curtain on these massive, mind-blowing failures to uncover the real, underlying secret of trading survival. So let's dive right into the minds of the brilliant, the bold, and, well, the utterly devastated.
I want you to really think about this paradox for a second. How does a Wall Street legend or a brilliant, highly educated banking golden boy just lose absolutely everything? I mean, how does a single young trader destroy an institution that survived for over 200 years? Well, the answer to these catastrophic collapses, it isn't a bad analytical strategy or a simple miscalculation. The answer lies much, much deeper. It's hidden in the psychological traps that turn giants into tragic heroes. Take the story of Jesse Livermore. Here was a guy with zero formal education. He actually ran away from home at 14 just to avoid being a farmer, starting out as a mere board boy in a brokerage. And yet, by predicting the massive market crash of 1929, he walked away with an unbelievable $100 million in profit. Back then, they called him the Great Bear of Wall Street. A single word from this guy could literally move the markets. He was practically writing the rules of the game, completely cementing his status as an untouchable market genius. But Livermore's ultimate downfall wasn't some flaw in his technical analysis. It was trap number one, destructive pride. You get a massive string of wins, and this sort of God delusion creeps in. You start to think you have the market completely figured out, that you're bigger than the rules you created to get you there in the first place. Livermore himself later wrote that his biggest mistakes happened when he couldn't stick to his own rules. Driven by this immense arrogance, he broke his strict trading parameters. A friend gave him a hot tip on cotton. Now, instead of trusting his own rigorous, proven analysis, Livermore took a massive emotional gamble on an asset completely outside his true area of expertise, based purely on that tip. And when the market moved against him, he lost a fortune, simply because his pride would not allow him to admit his friend was wrong and his own initial instincts were right. He felt invincible, and frankly, that invincibility was poison. Fast forward a few decades, and we see a 28-year-old golden boy named Nick Leeson fall right into trap number two, hiding losses. Leeson worked at Barings Bank, right? This was a 233-year-old giant that had literally financed the Napoleonic Wars. They serviced the British royal family. Nick was their star derivatives trader in Singapore, bringing in massive profits. But then he fell into a deadly black hole. And what is truly terrifying here is the sheer scale of the escalation. It started as a minor 20,000-pound mistake. A junior employee accidentally bought financial contracts betting on future prices instead of selling them. That should have just been a slap on the wrist. But Nick's pride couldn't handle shattering his golden boy image, so he hid it in a secret error account, the infamous 8888 account. He tried to trade his way out of it, doubling down again and again and again. Then, the Kobe earthquake hit Japan, crashing the Tokyo stock market. That hidden mistake ultimately turned into a $1.3 billion loss that entirely destroyed a 233-year-old bank, forcing it to be sold for a single pound. 1 pound. So, the absolutely crucial point here is to reflect on our own habits. I want you to look at your own trading dashboard right now, or, just picture it in your mind's eye. Ask yourself, honestly, are you holding on to small losses, just praying the market magically turns around? Are you ignoring a small tumor of a loss, letting it grow into a terminal financial disease? Remember, your first loss is almost always your best loss. Accept it and move forward. Because when you don't accept it, when those painful losses finally do hit, they trigger a deeply human, deeply dangerous instinct. And this leads us directly into trap number 3, revenge trading. This is the vicious swamp where logic goes completely out the window. Revenge trading is when you execute angry, high-volume trades immediately after a loss to try and force the market to give back your money. Instead of stepping back and analyzing the data calmly, you fight the market out of pure anger. It's like you want to literally punch the market in the face and get your stolen money back. And this is exactly how Nick Leeson dug his billion-dollar grave. After the Japanese earthquake, he abandoned all logic, doubled down with massive volume against the market trend, and tried to force a win out of sheer desperation. The only proven antidote to this incredibly destructive cycle? Immediate physical distance. You must step entirely away from the screen. Just turn off the computer, go for a walk. Do not trade for the rest of the day. You absolutely have to let your emotions cool down. The market is always going to be there tomorrow, but if you let anger blow your account down to absolute zero, well, there is no tomorrow for your trading career. However, taking a massive financial hit doesn't automatically mean total ruin. Let's look at some lessons from market survivors. Let's examine those who absorbed the worst blows, took heavy damage, and lived to tell the tale. Look at the stark contrast in behavior here. While Livermore and Leeson stubbornly fought reality and hid from the truth until it utterly destroyed them, billionaire hedge fund manager Bill Ackman took a radically different path. Back in 2012, Ackman took a massive short position against the company Herbalife, publicly calling it a pyramid scheme. Well, the market sharply disagreed. Rival investors drove the price way up. Over 5 years, Ackman was bleeding cash, losing hundreds of millions. But here is the major difference. Unlike the others, Ackman ultimately broke the cycle. He swallowed his immense pride, closed his position, and accepted a nearly $1 billion defeat. And Ackman's comeback proves the absolute power of accepting failure. By swallowing his pride and learning from that agonizing defeat, he sharpened his focus on risk management. Fast forward to February 2020. Sensing the incoming economic danger of the pandemic, he didn't make some reckless, unhedged bet. Instead, he used a highly intelligent risk management strategy, buying $27 million worth of protective hedges for his portfolio, which is essentially financial insurance against market crash. When the market plummeted a month later, those hedges paid off astronomically. He famously turned that $27 million insurance play into $2.6 billion. That's nearly a 100x return in mere weeks. He rose from the ashes like a phoenix, all because he learned how to lose properly.
Ackman's incredible recovery beautifully highlights the core truth of this entire explainer. Psychology is the trader's ultimate survival secret.
It wasn't just that he had a better financial model in 2020. It was that he had completely mastered his own mind. Trading survival is only 20% strategy and a massive 80% psychology. You can honestly be the greatest technical analyst in the entire world, but if you lack mental discipline, if you let your emotions dictate your trade sizes, you will eventually join the 90% of traders who fail. Strategy is just the vehicle, but your psychology, that is the steering wheel. These historical figures prove beyond a shadow of a doubt that your greatest enemies in the market aren't Wall Street whales, they aren't sophisticated trading algorithms, or unexpected bad news. The most dangerous enemies are the untamed emotions looking right back at you in the mirror. It's the pride that makes you hold a bad trade, the fear that makes you panic sell, the greed that makes you overleverage, and the blind hope that keeps you bailing water in a sinking ship. As we wrap up, I want to leave you with a crucial question to reflect on regarding your own journey. Really look inward. Which of these psychological traps, pride, hiding losses, or revenge trading, is quietly destroying your portfolio right now? Because ultimately, the most important capital you bring to the market isn't the money in your account. Your mind is your most vital trading capital. Protect it at all costs. Thanks for joining me on this explainer and keep learning.